This is the busiest week of the earnings season, with about a third of the S&P 500 companies reporting. 5 of the magnificent 7 companies also on deck this week. For more on the markets and the earnings season, we want to bring in Kara Murphy. She is Chief Investment Officer at Kestra Investment Management. And Kara, thanks for coming in today.
Thanks for having me.
I guess so far, so good is what we would say about things at this point.
Pretty much. I mean, this week will be the Magnificent 7 show, right? With 5 of the 7 reporting, it'll be extraordinarily important. Collectively, those 7 names are expected to grow earnings by about 18% year over year. I mean, that's an extraordinary rate given the incredible earnings growth that they've seen. But these names have to show up, they have to represent, and they have to get people excited about moving forward, right? It's not just about this quarter, it's about what happens into 2025. When you look at everybody else, though, you know, the 490 plus are expected to have flat earnings this year. So these guys just have to come and they have to not blow it.
If 1 or 2 of them misses, I mean, that could really drag down the averages because they make such a big portion, make up such a big portion of the averages at this point.
Absolutely. I mean, that's the risk of having this very concentrated market, not just in terms of market cap, but also in terms of earnings power. So any one can really kind of muck up the party, for sure.
You say that there is a bit of a shift that's taking place, though. If you look at this quarter and maybe into next quarter, what's happening beneath the surface?
Well, it's pretty incredible in that you continue to see Magnificent 7 with this great earnings power going into 2025, but still not as great as what we've seen in the past. And at the same time, you have the rest of the market that will start to accelerate earnings. I mentioned that they have flat earnings this year, probably this quarter. Into next year, we start to see double-digit earnings. So there's this big shift, and there has to be this handoff from the guys who have led us here and to what happens next year.
Is that likely to happen? I mean, I know you like mid caps overall, but if you look at small caps, I mean, that's been an issue for a couple of years at this point.
100%. So this has to be about the Fed navigating this kind of like soft landing or no landing. We need a more favorable interest rate environment to allow a lot of these firms to see that earnings powers really pull through. But it's a bit of a fine line in order to get there. Small caps, I think, is where you start to get a little bit more risky, where those folks are much more sort of susceptible to the macro environment. Mid caps, you're a little bit more protected with more solid, more mature businesses.
I've also just heard people talk about how if for smaller businesses, it's a lot tougher to get loans that are reflective of what the Fed's doing right now. They're still looking at very high rates for things.
It's true. And even when you look at the Fed interest rate cuts that we've had so far, it's only 50 basis points. So we're still well above what many of these companies had gotten used to a bunch of years ago. So it will take time for that to really filter through.
And if the Fed does not continue to cut rates?
That will be less of a tailwind for these smaller companies. Again, why we prefer kind of smaller end of large cap into mid cap. These are folks that are not as reliant as those interest rates coming in. They simply need a decent operating environment in order to grow earnings.
What about the bond market when you look at debt? How do you feel about that situation?
So there, when you look out to high yield, that's an area where we don't feel great about. You know, you're well out onto the risk curve. As you said, like there's some tailwind from lower interest rates. But when you look at spreads, those are among the lowest that we've seen historically. So as you go more into corporate, that's where we're a bit more comfortable. Again, more mature businesses, spreads aren't quite as tight, and so we're more comfortable in that area.
It's been a pretty phenomenal year watching the market. You think we'll get the post-election bounce we typically get?
We're a little less excited about a post-election bounce. I mean, part of it is just looking at how extraordinarily well the S&P has done overall heading into this period. Volatility has been, even though higher lately, has been relatively low for an election year. And I think we might have pulled forward some of those gains heading into the latter part of the year.